Hello and welcome to our channel 5 Minute Finance. Investors love the systematic investment plan (SIP) method of investing in mutual funds. This is evident from the fact that last financial year, that is in 22-23, mutual funds collected an enormous sum of over 1.5 lakh crore rupees through SIPs. So whether you are a seasoned investor or just starting out, these 8 important points about SIP in mutual funds can really make a difference in how you invest and what you get in the end. While some points may be an eye-opener for you, others may help you earn better returns from your SIPs. So let's get started. Just like exercising daily to build endurance for the trek, SIP is a slow and steady method of investing where you take gradual, small and regular steps to build wealth over time. Let's go through these 8 key points to understand SIP in mutual funds better. Did you also believe that SIP is a type of mutual fund? Well, that's incorrect. SIP is just a mode or method of investing which allows you to invest on a regular basis, say monthly, in a disciplined manner in mutual funds. You can select any mutual fund scheme that suits your risk profile and time horizon and start investing in it through SIP mode. Well, as said earlier, SIP is just a mode to invest in mutual funds, and since mutual funds invest in stock market and debt markets, your SIP investments carry the market-related risk. Investing via SIPs do not provide any kind of guarantee of returns. So what you need to do is select the right funds as per your risk appetite, and if you need help with it, you can go to the ET Money app and take the Investor Personality Assessment. Now, Investor Personality analyzes the factors that influence your financial behavior. It also helps you to build a portfolio that matches your risk profile and personality. The best part about SIPs is that you can select any amount as per your budget to invest via SIPs. You can start with an amount as low as 500 rupees and go up to investing thousands or lakhs every month through SIP. In fact, if you are facing a financial crunch, you can pause or skip your SIP anytime without any penalty as well. Imagine your money growing like a snowball rolling down a hill. That's compounding for you. Your earnings earn more earnings. With SIP, time is your best friend. Even your small investments can create significant corpus for you in the long term. Now see this. If you invest 1000 rupees per month for 20 years at 12% annual returns, you will accumulate 9.9 lakh rupees. But if you invest just for 5 more years, your corpus will grow to almost double, that is 18.8 lakh rupees. The best way to earn top returns in the stock market is by timing it. That is to invest when the market is at its lowest level and redeem when the market reaches its peak. But how many of us can time the market right? Well, nobody, right? It's almost impossible. So what to do? Well, a better way would be to give time to your investments. See the table on your screens. So if a person invests for a year, the chances of losing money are approximately 17%. But if he remains invested for more than 5 years, the likelihood of losing money falls to 0. So you can see how the likelihood of losing money decreases as your investment period increases, and the probability of getting good returns increases as well. SIP is not a get-rich-quick scheme. You need to be consistent to make the most of your SIP investments. When you do not invest consistently and skip an SIP installment, you end up hurting your overall wealth creation through SIPs. Now see this. Suppose you started a 15,000 monthly SIP in an equity fund for 20 years. Now at 12% rate of return, you would have made a corpus of 1.5 crores after 20 years. But if you had skipped only one SIP every year in this 20-year period, that means you invested only 2.8 lakh rupees lesser during these 20 years. But your total corpus would have fallen by almost 40 lakh to 1.1 crores. Seems sinful, right? So make a thoughtful decision when you want to pause or stop your SIPs. Suppose you buy apples worth 1000 rupees for 5 days in a row. On day 1, if the price of apples is 200 rupees per kg, you could buy 5 kgs of apples. Next day, the price of apples fell to 150 rupees per kg. So you could get 6.7 kgs of apples. Similarly, the details of price of apples and the quantity bought for next 3 days is given on your screen. So what has happened here? When the apples were available at a discounted price, you could get more apples. And when the apple price shot up, you could get few apples for the same money. This regular buying also lowered the average cost of buying apples. So we bought apples at an average price of 193 rupees per kg, which is way lower than the current price of apples, which is 225 rupees per kg. SIPs work in a similar way. But when the stock market is up, you get lesser units, and when the market is down, you get more units of mutual funds for the same price. And when you continue your SIPs for a longer period, your purchase price to buy 1 unit of mutual fund averages out. So over the long term, the average purchase price achieved via SIPs translates into higher returns. Take a look at the numbers on your screen. A monthly SIP of 5,000 rupees in a mutual fund that gives 12% rate of returns can create a corpus of 50 lakh in 20 years. Now, what if I tell you that you can double this corpus by making a small change to your SIP? Well, if you're wondering, there is no magic. But if you just increase your monthly investment by 10% every year, which means in year 1 you will invest 5,000 rupees per month, in year 2 you will invest 5,500 rupees per month, and year 3 6,050 rupees per month, and so on. You will be able to accumulate 1 crore rupees in 20 years. You can increase your monthly SIP seamlessly on ET Money at any time. These small additions every year will compound to make a significantly bigger corpus in the same time period. This brings us to the end of this video. I hope by now you would have cracked the SIP code. Now it's time to unlock the value by investing in mutual funds on ET Money, where you do not have to pay any commissions. ET Money allows you to invest in mutual funds for absolutely free. So if you like the video, subscribe to our channel and share the video with your friends as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.